I'm Charlotte McLeod with investingnews.com, and here today with me is Brien Lundin, editor of Gold Newsletter. Thank you so much for being here. Great to have you.
Great to be with you as always, Charlotte.
Really good to be catching up. And of course, our last conversation was in March at PDAC.
Yeah.
And I want to start by looking back to that time. So when we were speaking then, it was much different than it is today. We were still talking about it being a challenge for gold to get to the 2100, 2150 level. So of course, we're much past there.
Yeah.
So has gold's performance since then surprised you?
Yeah, it really has. Back when we talked, this new bull run was about 2 days old, and we still had not figured out what was driving it. And we still had no idea if it was real at that point in time. But real it was for the next 4 to 6 weeks thereabouts. Gold went on a virtually unrelenting run. I mean, setting new records every day, hardly a pause, and we didn't have really any idea what was driving it. About a month or two into it, we figured out that it was central banks buying, particularly the People's Bank of China, as well as domestic Chinese demand, Chinese buying on both the Shanghai Gold Exchange, physical exchange, and the futures exchange. And they were buying and chasing the price higher, which is highly unusual, not conforming to past patterns. And they were buying because there was no other thing they could buy in the Chinese market. Stocks and real estate were down. So it wasn't a trend that anybody really understood well at first, and it wasn't one that investors could really project very far into the future, and it wasn't what we expected, which was a Fed pivot as being the main driver. So we haven't had much participation by Western investors in this rally as of yet. The good news is that Fed pivot that we were expecting, and I think still expecting to some extent when we last talked, has been postponed, but it's still ahead and it's growing imminent. Yet the price of gold, when you would have expected it to maybe drop a couple $100 if the Fed pivot was being postponed, instead we're about $300 higher. So we're going to hopefully take off with that big new factor from a much higher price level. So it should be good for everyone. It should be good for the miners as well.
Okay, I think that was a really good overview of what we have.
Kind of long-winded though, wasn't it? Yeah.
No, it was comprehensive. So we're here at the Rose Symposium, and I got the chance to see your talk yesterday.
Yeah.
And one of your, I think, important takeaways was that this gold bull market is based on monetary factors. So I think that's just what you're outlining there. Is there anything you would add there? Because that seems pretty key. Yeah,
that's what drives any long-term bull market. I dismiss any geopolitical factors for gold. Those are usually very short-term reactions and really nonsensical reactions in my view. If you look at the three bull markets as I would define them since gold became a investable asset and not money in 1971, we had one in the early 1970s, one in the later 1970s, and the 2000s. And I think we're in that kind of a market again. I think from that period, from like 1980 on, we've had a 4.5-decade run of ever lower interest rates, ever easier money. And I think we're at the in the end game of that long trend. And currencies, not just the dollar, but primarily the dollar, are losing credibility of each crisis and each Fed reaction. And I think gold's going to be the last asset standing at the end of it all, and I think currencies will have to reattach to gold at some point. So that's my primary thesis that I was trying to get across in my presentation yesterday. The timing and degree is the hard part. We really don't know, but I think we're going to be in that kind of a bull market like we saw twice in the 70s and through the 2000s.
Okay, and speaking of the Fed, so you said yesterday, but you said also many times in the past, the Fed is really coming up against this massive wall of debt.
Yeah.
And so with that in mind, when do you see that rate cut potentially happening? I feel like we've had so many different calls this year.
Yeah, and it changes on a weekly, even sometimes daily basis, depending on the flow of economic data. Now, in recent days, as we speak, we've had some softer economic data, more benign readings on inflation, and the odds of 2 rate cuts before the end of the year have risen, and the odds of a September cut have risen. So, yeah, I think that's about what we'll see. You know, we are likely to see a couple this fall. More importantly, I think the markets are just starting to price that reality in, and particularly with gold. We were in the summer doldrums, and kind of comfortably so, nobody really expecting a breakout. Then, as we speak, about a week and a half ago, I realized that the Bollinger Bands for gold were tightening. In other words, volatility was collapsing in the gold price action. And that has usually presaged, as actually every time since in this rally that's happened, it's forecast a breakout to the upside. And I think we're getting that or seeing that now. We saw that last week, and as we speak, we've kind of settled back a little bit. But I think gold price is going to start factoring in that Fed pivot over the days just ahead.
Okay, and I think I have to bring up another comment from not your presentation yesterday, but your panel where Rakul was the moderator, and he had asked for possible negative surprises when it comes to gold. And I think your scenario was, what if we get the Fed pivot and gold's price move has already been priced in? So that's the end of the road for gold. So I would love to hear more about that.
Yeah, you know, back at the gold price peaked in 2011, and few people realize it, but that was almost exactly coincident with the Fed's announcement of QE infinity, basically that they were going to continue quantitative easing for as long as, and to whatever degree, was necessary to achieve their desired results. That should have been the quintessentially bullish announcement for gold, but it marked a peak for the price in that move. My take on that is that at that point in time, the gold price was driven primarily by Western speculators and primarily in the futures markets on COMEX. And those traders were betting on each Fed announcement, QE1, QE2, QE3. When it got to QE infinity, they realized that the next announcement would be the end of QE, and so the trade was off at that point. So they exited. I fear that maybe gold has predicted this Fed pivot and already priced it in, but that said, the Western speculators have not been driving this market to any degree. So I think that those factors that have been driving it, which are somewhat absent or from the U.S. market, will still be there to some degree. And then we'll get the Western speculators actually coming in and the generalist investors coming in at that point. So I'm bullish on it, but that would be my primary worry, is that gold is a very predictive, highly predictive mechanism.
Okay, very interesting. And anything else you would add on this divide between Eastern and Western investors right now? I feel like that always exists, but it seems to really be at the forefront of conversations right now.
Yeah, you know, we were talking earlier before we got on air that what a lot of people are using to describe, the term a lot of people are using to describe this market is weird. Well, I'm sorry, I'm going to use that again. It is weird, it is unusual, because the Asian investors, the Chinese investors particularly, have been following the price trend up. That's highly unusual. Usually it's the Western investors that follow the price trend up, and Chinese and other Asian investors buy on dips. That pattern may reassert itself, but it has to reassert itself on both sides for us to have a really good bull market. In other words, the Western investors have to keep buying, and the Eastern investors would have to come in and kind of support it on dips. I think it's going to happen primarily because the monetary issues, again, are going to be so overwhelming. I think that they argue for much higher gold prices from here.
Okay, and another factor, I don't think we've talked about this yet, but it feels like it's getting to the right time to talk about, is U.S. election. So is this something that you were watching closely when it comes to gold? or when it comes to making investments in the mining sector?
No, not at all. I don't think there's going to be any significant difference. I think that neither party has proven to show any fiscal restraint, any cutting in spending, and perhaps under Trump there may be an easier path to permitting for a number of mining companies, so that would be welcomed. But other than that, I think both sides of the aisle in the U.S. are basically committed to overspending, and there's not much they can do about the debt at this point.
Okay, so keeping all these factors in mind, we've gotten to historically high gold price levels this year. Do you have a next level that you're looking for at this point?
It's hard to say. I think clearing 2,400 for good, trading a few weeks above that level would be key. Eventually, I think we're going to go much higher. The timing of that is always the hard part. I am getting back to where I think we're going to be at the end of this cycle. I think the gold price is going to be somewhere between $6,000 and $8,000 an ounce at the end of this cycle. How long is that going to take? Who knows? But the near-term price targets, we're going to be, when we get a little bit over 2,400, we'll be back in uncharted territory. So from a technical standpoint, it gets a little tougher from then on.
Okay, and a topic that's really seemed to carry over from PDC when I last spoke with you and many other people is what is going on with the gold stocks. If we have the gold price moving so much, had they moved as much as you would have expected? And I think many investors want to know, when may they move more?
Yeah, they have not moved as much as people would have expected. They have, for the major indices, they have leveraged this move in gold, but not as much as we would have expected. I think that's going to come. I think the generalists are going to come into the market once they have a theme that they can project forward, being a Fed pivot, a Fed move to the rate cutting half of the cycle. That's the kind of thing that the markets will be able to look forward a couple of years and feel confident that it's going to continue and provide those tailwinds for gold. We had an interesting kind of circumstance on April 22nd when the price of gold dropped $60. And then there was the next day or the day after, with the gold price still remaining stable, having stabilized, that Newmont had a 10% up day. And what that signified to me was that generalists were ready to get in on board if there was a pullback that they could take advantage of. Newmont's the only gold stock that's on the S&P 500, so it's the natural port of entry for generalist investors into the mining sector. So I think they're ready to jump in. I think the two things that have prevented it up to now was a thesis that they could project forward, and an entry point, a pullback in the gold price that they could take advantage of.
Okay, and of course, I always love to talk about gold, but for you right now, any other metals or commodities of interest?
Well, silver is naturally going to leverage gold because it always has in a monetarily based bull market, a secular bull market. So I expect it to do that again. I think the story for copper is undeniable. It's harder to play that in the junior sector because a lot of the copper projects that are advancing or very large are done in concert with majors, where the junior's interest is somewhat diluted. So it's not as explosive as gold and junior gold stocks may be. But it is the kind of a story which I think is completely independent from the monetary story for gold. The electrification trend will have tremendous builds a tremendously steep demand curve for copper. So I think that it's the kind of a play that you just set it and forget it. And, in 3 or 5 years, you'll be very pleased with the copper investments if you make the right investments in quality companies today.
Okay, and I think last question, usually I check in with you on your portfolio and ask you if it's fully allocated or you have space to take advantage of opportunities.
I have to sell something to buy something at this point. And it's still not a good market to sell into. There's still not a lot of volume. That said, I do personally have to do some maintenance on my portfolio because there's about a half dozen opportunities out there that I think are just, slam dunks, as it were, and that I don't own or don't own enough of that I want to take advantage of. And yeah, I've got to switch my portfolio around and try and reallocate it. But I am fully invested and at this point waiting for this market to reward me.
Okay, I think that sounds like a great place to wrap up unless you had any final thoughts that you wanted to add. We do have your event coming up in November.
Yes, let's add that. The 50th anniversary New Orleans Investment Conference, November 20th to 23rd. And great event. All the cool kids are coming. I hope you'll be there. And goldnewsletter.com. You have a free report on how to invest in the sector. So.
Very good. Thank you very much. And do look forward to hopefully seeing you again in November.
Looking forward to it, Charlotte. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Brien Lundin. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.